Hi everyone, it's Sean Sandilands from Pulse Markets here with Dr Manny Pohl from ECP Asset Management. Just getting an update from the end of financial year, how things went. Good morning, Manny. How are you?
Yeah, very well, very well. Thank you, Sean. And nice to see a lovely skyline, which we haven't all seen for a long time, I must add, which is a pity. But anyway, we look forward to flying and going to visit lovely San Francisco at some point.
It does make me feel like I'm not in Sydney, but it is a bit of fun. Listen, getting down to it, because I know you're a very busy man, can you tell our investors and people out there a little bit about ECP Asset Management and your listed investment companies, please?
Yeah, sure. Thanks for the opportunity to talk to your client base, and hopefully one day we'll meet everybody in person. ECP Asset Management is a traditional funds management, boutique fund management business that was set up probably, I think it's like 8 years ago now. And it was really set up by one of my sons and myself when we came out of Hyperion. I was the major individual shareholder in Hyperion and decided I wanted to follow my own path. So we left Hyperion and set up ECP. Subsequent to that, obviously from a standing start, we're now managing close to $2.5 billion in institutional money. And for those of you that are in the retail space or clients that are in the retail space, we set up a couple of LICs to give them access to what we were doing. And that's the genesis of both Flagships Global and ECP. In terms of how ECP and Flagships fit together, our first cab off the rank, and I set it up years ago, was Flagships, which is the stocks that we would pick in the overall market. But clearly, because we got a small to mid-cap focus, a number of people were saying, can we get something that's specifically at that end of the market? So that's where ECP came about. It was originally called Barrack Street, and it's there, and it's purely the X50. So anything that's in our standard portfolio that's in the 50 is in that, whereas Flagships is the broader portfolio, including the miners or the banks if we decide to put the big stocks in there.
Okay, that's great. We've noticed that your LICs have performed very well over the last 12 months throughout COVID, which is quite impressive. How has the performance been of Flagship?
Yeah, look, I have to say, there's a lot of people that have got economic hardship, and the world is not really hasn't been in a good space during this whole COVID thing, but our investment performance has been top draw. I mean, clearly we're waiting for the June numbers to come out and the surveys to come out, but I would be very surprised if we're not within the top 3 within Australia, given the performance over the past 12 months. And that's been driven because our focus has always been on sustainable business. Sustainable business is businesses where the management team have a model that enables them to direct the company to do well in various economic situations. But more importantly, they're capital light, and we have always had a technology focus. So as you know, through COVID, any business that had a technology focus is the ones that have been performing dramatically well. So that's been our case. Our performance has been excellent. But as I said, we're waiting for the final numbers to come through for June. But that I'm talking about the 12 months now.
Okay, that's very exciting. We're looking forward to seeing those as well. We have noticed that you've got a basis towards growth companies or a bias towards growth companies. Yep. Can you give us a little bit of your logic behind that and your reasoning, please?
Yeah, sure. I mean, we get put into the growth bucket because asset consultants and research houses like to put people in a bucket. So they'll put you in a sort of a value bucket, or they'll put you in a growth bucket, or a style neutral, whatever they decide is the way they want to categorize managers. For us, it's actually a bit more simplistic than that. We're a bottom-up fund manager that identifies what we believe sustainable long-term quality businesses. And for us, the definition of a sustainable long-term business that grows its economic footprint and then grows shareholder wealth, which is what we're interested in, we're just shareholders, are those that have the ability to expand their economic footprint. So if you've got a company that's going sideways, or even if it's in an industry that's declining, we don't want to even be anywhere near that. We want to see a business that has the ability to improve shareholder wealth. And fundamental to that means it has to be growing the economic pie. That's why we invest in those sort of companies. So we don't believe in buying something just because it kind of looks cheap or on some metric, or it might be a cash shell that somebody might inject something in, we look at the businesses, we look at the track record, and when we decide that that is something that we would like to own and on the long-term basis, that's what we do. But as part of the definition of decent businesses, they have to be able to grow the economic footprint, and all the metrics relating to that put us in the growth bucket. So that's how we end up being defined as growth, but it's purely because we want to invest in sustainable businesses that we end up in that bucket.
That makes a lot of sense. Thank you. We've been following you for quite some time, and 12 months ago, you wrote an article that was very positive about earnings, particularly for quality growth companies. That was 12 months ago, and obviously the markets have rallied quite sharply, and it's been a very good market to invest in for our clients as well. How do you see the market looking over the next 12 months, where we do see all of the international and domestic markets at quite high levels? Do you see further growth opportunities there if you're selective?
Yeah, so the high levels obviously relate to the multiples we're seeing. And over the past 12 months, we've had the kicker of the good earnings that I was talking about, and we've had the expansion in PE multiples. And those together have given us a dream run where the market's up 25 and we're up wherever we are, but which is obviously more than that. But it's as a result of those two factors. From here on out, the models that we run are suggesting that the earnings are still going to be growing at about 13 to 15% for the portfolio that we run. Compared to historical terms, it's probably a little lower than what it's been, but it's come off, 12 months ago, it was off a really low base. That base has improved. So off the current base, that's the level we see going forward. But we're going into reporting season. And my expectations are that the reporting season, we are going to see our companies, not the market as a whole, but our companies have actually done better than what we were expecting. So the outlook means that it'll be again off a higher base, and it might be the figures as we revise them for the next 12, 24 months, 60 months, could be a little lower than what we've seen historically, but that's because there's been a massive run up over the past 12 months.
Okay, great. You've been delivering top returns for the last 20 years.
Yep.
Can you give us an insight to what is the secret of your success? And do you think you can keep going the way you've been going? Because I think that's what a lot of people want to know.
I mean, Sean, I don't mean to be flippant, because your audience are clearly very sophisticated and serious people about their money. But I've got a little gadget here. I don't know if you can see it. I just twist this and it says buy, sell, hold, go for broke. I jest. No, the secret of the success is really, and I know this is like common stated by most people, it's having a good team around me. So the key thing about a boutique is the culture within the business. And the guys that I've got within the business working around me are as good as you can get in the market. And I think they're probably world beaters. They're top of the draw. So it's about the culture of the people within the team. But you actually have a process. And I've written, if you go and Google me way back, I wrote a lot of articles on a disciplined process to investing. And anything you read about Buffett, who's probably the guru of everybody, he talks about that as well, thinking about things logically and looking at actually what it is you're doing. So we've got a robust process that we follow, but it's not like ticking a box saying, oh, it's got to be ESG or whatever. It's about a robust process to get to the essence of the business and to get to the essence of whether it's sustainable or not. And part of that process is we keep each year, we look at what we do and we see if there's anything we can do better. And this last year, the internal navel gazing exercise we did, Jason, one of our team members, he had been doing a lot of work for his PhD, and there's a thing called dynamic capability in a business. Now, what the hell does that mean? Well, it means that the business has to be like investing in R&D or investing in its staff to keep rejuvenating the business to ensure that, yes, it continue to go forward and strive and do better all the time, the sort of the apples of this world, the Google. So that's what has enabled us to have this ongoing success, is that we do look at what we're doing, and if there's anything we can do better, we do that, because we perform, my own money is the same as it is, all my money is in Flagship, so if that performs well, our investors perform well. And the shareholders get more wealthy over time. So to answer your question, I know I'm sort of making a bit of a long-winded answer, but it's about having a quality team of really talented individuals who follow a way of analyzing the companies And those companies are put into a portfolio in a consistent way that enables us to continually outperform the indices. And we've done that through 87 crash, the GFC. In fact, the GFC, I received a lot of accolades for being the best performing manager. And that really comes down to the quality of the businesses that we own. They have strong balance sheets. They have a growing profile, which we spoke about earlier. They give us return on equity, which is what we want to see. So all of those together in a pot of, again, as I'm repeating myself, a team of guys that follow a process to analyze that, to determine whether it's a quality business. You put those quality businesses together and that portfolio performs. So it's not twiddling the dial with that thing that I showed you. It's actually going through a process that gets to the essence of the business and then putting them together logically, and then that produces the results. So we don't chase the results. The results are an output of the work that we do. But if you look at the tables, it certainly puts us in the top quartile all the time.
That's impressive. Thank you for that. That sounds really impressive. One other thing which I guess my investors and a lot of people out there are talking about at the moment is inflation with such cheap money. How do you guys manage, or how do your portfolio manage inflation risk with regards to stock selection and portfolio construction?
Yeah, look, that question would, I think, be a little more difficult for other managers. It's actually a very easy question for us. And for a couple of reasons. Inflation to me, and inflation trickling up, as you just mentioned, is not a problem. The alternative, deflation, is the thing that I worry to death about, because what it means is that the price is going down, so then consumers hold off on their buying. So the revenue line that we want to see in these growth businesses that we've got stops going up and it starts to go south. And then the managers of those businesses have to deal with a problematic environment. So slight inflation for me is actually perfectly fine. It means that there are consumers that are chasing probably scarce goods. In our world, the thing that worries us when we look at the companies we're in is that inflation, if it starts to pick up dramatically, it means that supply lines and the goods associated, or the commodities or the input costs associated with supply lines, suggest that maybe there's a restriction in that and businesses can't get what they need. And that's what's driving the price up. But we're not seeing that as a major issue at all. The level of inflation is not a problem. But if it was to happen, because we take a lot of time in identifying the great businesses with a talented management team, those guys are at the rock face managing that business to deal with these sort of problems. And that's why we pick the businesses, because we believe there's a talented management team. So we allow them to navigate their quality business through the minefield and through this environment of increasing inflation or even deflation. And we're backing them. That's what we're doing, is we're backing this management team. And they know more about the businesses than we'll ever know. I mean, we're a one-day expert in their business. They've been highly successful because they know everything about it. And we're relying on them to deal with this particular issue. So we allow the businesses we're in to deal with whatever the macro world throws at us, whether it be high inflation, high interest rates, or whatever. The management team deal with that issue. In terms of high interest rates, because our companies have got low levels of debt, because we favor capital light industries, that is never really a problem for us, because as interest rates go screaming up, they have cash on the balance sheet, so it's beneficial. It's not a major expense to them. But in short answer to your question, the great businesses that we're investing in, we rely on that to actually navigate whichever the problem might be, wherever it comes from.
Okay, great. Lastly, we did speak about your LICs, FSI and GFL.
Yep.
I noticed there are no management fees in either of them, which is quite unusual. You mentioned you invest alongside them or internally in them. That's something quite substantial. How can I invest in those if I wanted to, for my investors, just to get some diversification, or people out there? How can they actually invest in these LICs direct?
Oh, right. Well, they're all listed on the ASX. So as long as they've got an account with somebody like yourself or E-Trade or whatever, as long as they've got access to a broker or a broker's network, they can buy them on the market. They're quoted every day and they're reasonably liquid. Unless, of course, you want to buy 1 million shares or something, then you'd have to call me directly. Because we have got obviously a lot that we own, and for selected individuals, we would let some go. But yeah, they could buy them on the market without a problem. The one that I haven't spoken about is, and you raised the issue about the management fees. Funny enough, when I kicked flagships off 20 years ago, I thought that people were quite happy to pay a fee if you performed. They didn't want to pay you a fee if you underperformed. That was what a lot of retail guys said to me. Oh, in this industry, you bloody people, you earn a fortune even whether you lose me money. That doesn't make sense to me. So that's how we structured particularly flagships, was that it had to be positive performance, and we only shared in positive performance in terms of a performance fee. There were no management fees. So we didn't get paid anything to do the job. We only got paid if we outperformed. In GFL, because it was more of a passive vehicle giving access to Berkshire Hathaway, we were not managing anything. He was doing the management, and we couldn't be entitled to a management fee. So that's why that ended up that way.
Okay, that's great. Well, listen, I'd really like to thank you for your time today. That's very enlightening. Is there anything else you'd like to say before we finish up?
No, not at all. I mean, thank you for the time. I hope your investors like what I had to say. They can clearly go to our website. We do produce stuff on the internet these days. There's a lot of material out there. We've got the quarterlies that you can download and have a look at them. But really, thank you for your time and for introducing me to your investors. So thank you.
Thanks, Manny. Have a great day.
Yeah, you too.